What exactly is corporate tax in the UAE, and what must businesses really know? First, corporate tax registration is mandatory. Even if your business has zero revenue, you must register. No exceptions. The deadline? Within 3 months from the date of licensing. Miss the deadline? Expect a 10,000 dirham penalty. Second, filing the corporate tax return is also mandatory. Even with no income, no activity, you're still required to file. You have 9 months after the end of your financial year to submit it. Now, let's decode your tax regime options. This is where strategy matters, because the regime you choose affects not just your tax, but also your ability to carry forward losses or claim exemptions. Option 1. Small business relief. You're eligible if revenue is less than 3 million dirham for each prior tax period that started on or after 1st of June 2023, including the current tax period. You're not part of a multinational enterprise group and not a qualifying free zone person. This relief applies to tax periods that begin on or after 1st of June 2023 and end on or before 31st December 2026, unless the minister decides to extend it through a separate official decision. It can be a great benefit. But watch out. If your business is making losses, this relief might hurt you. Why? Because under this regime, tax losses cannot be carried forward, which can reduce long-term tax efficiency. Option 2. Qualified free zone person. If you operate in a UAE free zone and meet specific criteria, you might qualify for the 0% corporate tax rate. But the rules are strict, and this topic deserves its own deep dive. So check out my separate video on the channel all about qualified free zone person. Option 3. Standard regime. 9% corporate tax. This is applicable to all others. 9% tax on net taxable income exceeding 375,000 dirham. It sounds simple, but there's a catch. Not all expenses are deductible. Fully non-deductible expenses include dividends or profit distributions to owners, corporate income tax, UAE or foreign, penalties and fines, excluding contractual penalties, bribes and illegal payments, donations to unapproved charities or non-qualifying public benefit entities, personal expenses unrelated to business, capital gains or losses on assets not yet realized, payments not compliant with the arm's length principle or lacking documentation, partially deductible or limited expenses, entertainment expenses like meals, events, only 50% deductible, interest expenses, limited to 30% of adjusted EBITDA if exceeding de minimis thresholds, payments to related parties, only deductible if made at market value and properly documented under transfer pricing rules, provisions for doubtful debts, deductible only when accounting criteria are met and supported, depreciation must follow accepted accounting and tax adjustments. Also, you must prepare financials in line with international financial reporting standards. Whatever regime you choose, maintaining proper accounting isn't optional. It's the foundation for your tax calculation. Next, let's look at one of the most overlooked but heavily regulated areas: related party transactions and disclosures. If your business deals with shareholders, directors, family-owned entities, or group companies, you're dealing with related or connected persons. And that means you must disclose related party transactions in corporate tax return if they exceed 4 million dirham with related parties, or connected person payments exceed 500,000 dirham, such as salaries, benefits, or other compensation to individual shareholders or directors. But even below those thresholds, the arm's length principle applies. Salaries, service agreements, loans, royalty payments, all must be market-based. To support that, you may need a benchmarking report. which you can prepare manually or with the help of tax advisors. And finally, if your business has 200 dirham million or more in annual revenue, and business has transactions with related parties and connected persons, you're required to prepare full transfer pricing documentation, a master file, and a local file, with detailed analysis and methodology. Bottom line, the UAE's corporate tax regime looks simple, but it's not plug and play. In the UAE, tax success is all about precision. Choose wisely, file on time, and document everything. Want to stay penalty-free and fully optimized? Stay informed, stay sharp, and don't miss the next video.